the whole point here is that this dollar is relentlessly being, again, catalyzed by what the government's doing. A deal to blast the U.S. deficit to oblivion. Okay? So understand that the whole world sees this happening. We're doing it at a much more aggressive pace, doing it both from a Fed money printing perspective and from a deficit spending perspective, and the dollar is going straight down on that. It's devastating for the people at a particular time, and now on the East Coast with millions of people with no power and a lot of people with no jobs, again, we're going to have a higher and higher cost of living through the lens of point number 2 this morning, which includes commodities. Volume continues to accelerate alongside rising prices and falling volatility. That's the commodities asset class. It made a new high yesterday from a cycle perspective. Now this, if you go back to June the 8th, so I circle that. This is called the curve, okay? The yield curve. You take the 10-year yield, subtract the 2-year yield, and on June the 8th, people say, oh wow, look, the curve is steepening because the economy is recovered. You buy the financials, you buy the airline stocks, you buy Hertz at $6 per share even though it's bankrupt. Terrible decision. It reflects the very basic economic reality that's getting you paid in your portfolio. It's only good for us, the small percentage of us who subscribe to the process and understand how to be long inflation before Wall Street chases it. And thank you, CNBC, for doing that for us this morning.